My name is Shane Handy. I am the founder of The Rational Trader. This is a 5-part video series on trading the markets using visual order flow. Visual order flow is a way to graphically display the order flow data so that we spend less of our time picking apart the data and more time applying it to what the market is doing. Our agenda is the first video, part 1, is Introduction to Wave Volume. This is a technique we use to help us choose direction. Part 2 is an introduction to order flow. This is basic concepts and a way to graphically display it so that it is easier to see what is happening. Part 3, there's a lot of ways to enter the market. We're going to look at one in particular, which is understanding breakouts. So when the market moves to a level, looking at the order flow to help us make a decision on whether we think that breakout's going to succeed or not. Part 4 is an advanced order flow view, looking at the data in a little bit different way and then displaying it differently to help us understand where is the momentum in the market. And then part 5 is bringing it all together, how I read the market using visual order flow. Now, before we get started, we need to talk about risk. So trading is risky, and you can lose all of your money. And with futures, because of the leverage, you can actually lose more than your initial investment. There's some other elements listed on screen here that are important, and I'm going to come back to them in a moment. But first, I want to talk about the nature of risk or the source of that risk. And I think this is something that people misunderstand, and as a result are focusing in the wrong area as they work to manage their risk. The first component of risk, the first source of risk, is the market itself. I call this the technical risk. The market, we are trying to predict the future. That is inherently risky, and as a result, we need to deal with that. This is what most people think about when they talk about the risk in the market. Dealing with the unpredictability, the probabilistic nature of trading. The problem is this is not the only source of risk, and in fact, I don't even think it's the most important component. More important is the physiological risk, or the biological component of risk. And what I'm referring to here is that when you put money at risk, your body responds to that threat in the same way it responds to every other threat. It initiates a physiological response that causes fear, anxiety, doubt, and the flip side of these, excitement, greed, and euphoria when things are going your way. This physiological response impacts your ability to make sound decisions and has to be dealt with. All right. The Rational Trader was designed to recognize that this is the largest component of risk that you need to deal with, and creates a program that is intended to help you overcome it. That's what the Rational Trader does. Now, let's go back and look at suitability, performance, and hypothetical results. Suitability is talking about do not trade with money you can't afford to lose, because you are likely to lose it until you learn how to trade. Okay? You need to start small. The other component here is that you may discover that you don't have, because of that physiological response, your trading is not for you. And if that's the case, the sooner you know that, the better. The next is performance. Two people can use the same method, the same technical method, and have vastly different results. And the reason is their physiological responses and how they deal with them as they trade. This is why person A can be successful and person B will fail, even though they're using the same thing. Okay. Hypothetical results are simulations. These do not have any element of the physiological risk at all, and are therefore useless. Just ignore them. Okay. With this in mind now, let's get started. This is part 2 of the video series, Trading the Markets Using Visual Order Flow. We're going to cover an introduction to order flow. You'll get a very clear understanding of what we mean when we say order flow. There's 2 specific concepts we're going to cover today. The first is bid and ask volume, which is really answering the question, what is order flow? And then we have to go over something a little bit more advanced, which is how order flow behaves within a range of prices, and you'll see why that's important in a few minutes. At the end of part 1, we covered an introduction to wave volume, and this is what the chart looks like with the wave volume studies enabled. As a reminder, we're building towards this. We're building towards a chart that will allow, that I use to actually read the market using visual order flow. So with an understanding of the direction that we think the market is going, or rather using wave volume to help us choose a direction, we now want to add order flow information into our decision-making process. And so to do that, we're going to add some additional information. And specifically, you see pink and blue bars now. The pink bars see increased selling, and the blue is increased buying, increased selling, selling, increased buying. And we're particularly interested in certain locations. And actually, for this series, we're going to be discussing how the market behaves at breakouts. And so I've left the zigzag on here because it really helps us see these different levels. We can see as we're breaking through here, we're seeing increased selling. Now we're going to cover exactly what that means when I say increased selling. How is that calculated? Same thing here. When we see the breakthrough of this level, we see increased buying. All right. Now something to consider is, look, when we broke this low, there's no indication of increased selling. All right. And in fact, when we broke this high, there's no indication of increased buying. So this is at a minimum, at the most basic level, this is a way to help you more intelligently enter on breakouts. Now we're going to discuss that in a lot more detail in part 3, because I specifically use this to help understand if I want to enter on a breakout. So let's cover exactly what I mean when I say increased selling or increased buying. And to do that, we have to understand how trades transact in the market. This is a dome for the NASDAQ. And what it shows is a series of prices in the middle and a number of contracts that are being offered to buy and sell. Okay, and so you have 10 price levels here where it shows that these people are willing to sell contracts at certain prices. And these folks here are willing to buy at certain prices. All right, so let's get a little bit more specific. At 58.1325, there are currently 30 contracts on offer. So what that means is, if you're willing to pay me 58.1325, I'll sell to you times 30. That's what that means at this moment in time. These numbers are changing constantly. At this moment in time, there's 30 on offer at 58.1325. This is called the ask quantity or the offer quantity. So I'm asking this price, 58.1325. Just below that, you can see there's 51 contracts on offer at 58.13. So if you're willing to pay that, I'll sell to you times 51. Some combination of people offering up to 51 contracts. All right, by the same token, down here at 58.0850, I'll buy from you if you're willing to sell to me at 58.0850 times 37. I'll buy from you, if you look at here at 58.10 even, 51 contracts on bid. This is the bid quantity. I'm willing to buy from you if you'll sell to me at 58.10. The price has to come down. The current price is too expensive. I'm not willing to pay 58.11, which is the last traded price. That's too expensive. I won't pay that. But I'll pay 58.10. Okay? So these are called limit orders. Now, this is the order book. And these price levels represent the interest that's sitting in the market. All right? Now, the last traded price was 58.11. Okay, and currently, at this moment in time, there are 3 contracts on offer at 58.11 and 23 on bid at 58.1075. So What has to happen for the next trade to occur? Think about it for a moment. There's currently 3 contracts on offer. I'll sell to you at 58.11 if you're willing to buy at 58.11 even. And there's also 23 on bid. I'll buy from you at 58.10.75 if you're willing to sell it to me at that price. There's no way for these 2 orders to meet. There's no way for the limit orders at 58.10.75 to buy can be matched with the orders to sell at 58.11. They're at different prices. The only way for that trade to occur is for a market order to enter the to be placed. Okay? Somebody somewhere has to say, okay, I'm willing to pay you 58.11. I think the price is going up. I don't think it's going to come down to me. I'll pay more. And if that happens, the next trade will occur at 58.11 even. By contrast, someone might say, well, I think the price is going down and it's not going to come back up to me. And they'll place an order, a market order, to sell. And that market order will execute at 58.10.75. This is the only way for these orders to be filled, is if market orders are placed. The only way. There's no other way for the market to move. The key point here is that if people believe the market is advancing and is not going to come back down to them, they're placing market orders to buy. They're being very aggressive. Every trade has a buyer and a seller. And so we can't just say, when we say there's more buying or there's more selling, that's really silly when you think about it, because every trade has a buyer and a seller. It's not that there's more buying or there's more selling. It's that the one side is being more aggressive than the other. And so what we really mean when we say I see selling is I see aggressive selling, or I see aggressive buying. And we see that by examining, well, where did the trade occur? If we look at the current moment in time, the split is 58.11 even and 58.10.75. If the next trade occurs at 58.11 even, then that was an aggressive order to buy. The buyer was not willing to wait for the price to come down. They want to get in the market. They're being more aggressive. That is an order that went off at the ask price. At the ask price here. It's really important that you understand this. If the trade went off at the ask, that means it was an aggressive buyer. Someone not willing to wait for the market to come down. By the same token, if the trade went off at 58.10.75, that was a seller that does not think the market's coming back up, and they need to get in. They need to place that order. They're willing to accept less for their sale. Aggressive selling. So if it goes off at the bid, if the trade goes off at the bid, that was aggressive selling. If the trade went off at the ask, that's aggressive buying. Now the software will track this for us. It'll show us for every trade that occurred, did it go off at the bid or at the ask? Now we can see this in the chart. This is Sierra chart, and there is a study called numbers bars. Numbers bars. Here are the settings for it. It's a very, very complex study. All right, if you're interested in the settings, here they are. And what this study does for us is it shows us exactly in the bar how many trades went off at the ask and the bid at each price level. So this chart is the same. This is the same chart as here. It's a 10-tick high range bar, okay, but it's displaying the information differently. It's showing us for each price level how many trades went off at the bid and how many went off at the ask. So if we look at this bar right here, at this top price level, which is 26.75, there were 28 contracts that went off at the ask, 44 at 26.50. there were 22 that went off at the bid at that price level. Okay, all the way down. So as the market trades up and down, the software is tracking, did that trade go off at the bid or the ask? And so if there were 100 trades in that bar, and 70 of them went off at the ask, the ask volume will be 70 and the bid volume will be 30. Okay, now there's some other things on this chart. Let's just get those out of the way in case you're curious. The lines, the red and green lines on the side are just helping us see, did the bar close up and down? Okay, so red means the bar closed down, green means it closed up. The yellow rectangle is the price level at which the most contracts traded. So it's called the high volume node. Neither of these are important for the current discussion, but if you're curious, that's what they are. What we want to do is we'd like to understand, okay, well, so in this bar, what was the total amount of buying and selling that occurred at the bid and the ask? And to do that, we can very easily see that by using another Sierra chart built-in study called, whoops, that's the wrong choice, called Numbers Bars Calculated Values. So if I unhide that, this is going to display along the bottom here. In this case, I've got it displaying 3 rows. We only care about the green and the red for the moment. The green is the ask volume. How many trades went off at the ask? This is the aggressive buying. Okay, so this area down here, this line, I just want to draw for me. That's interesting. And then below that is the bid volume, the red values. So if we look in this, this current bar here, we can see that 158 contracts went off at the ask, aggressive buying, and 127 went off at the bid, aggressive selling. And we can see that for every single bar. Okay. Now, what we want to do is we'd like to use this information to help us understand who's being more aggressive and who's being at key levels. All right. So is there aggressive buying in the market or aggressive selling in the market? The problem with this chart, there's a lot of information here, but it's really difficult to use it in real time because there's so much data here. And so what you can see what I'm doing is I'm taking this information and doing something to it, which I haven't described to you yet, and I'm displaying it in a graphical format that's a lot easier to work with. All right, so now let's go and see specifically what I'm doing here to understand that I see aggressive selling right there. Okay, if we look here, I can tell how much selling is going on. I've got the bid volume, okay? And in fact, I can tell how much buying is going on and the total. I've got all that information. Now, how are we going to use it? All right, let's take a look at the chart in a little bit of a different way. Let's switch over to the chart we've been working with, the 10-tick range bar chart. I've taken off the cumulative volume down here, so we're just looking at the 10-tick range bars and the waves, okay? And specifically, we're kind of focusing on these two areas to understand what they're saying. And in fact, for this discussion, for the purposes of teaching, I'm just going to focus on the selling. So let's do the same thing. Let's take the numbers bar calculated value study and let's turn it on for this chart. So it's a little bit easier to work with now. And the first thing you'll notice is that I need to change the scaling here because you can't read the numbers. So let's make it a little bit easier to work with. And so here we see on this bar that's breaking through here, we can see 117 trades went off at the ask and 365 went off at the bid. Okay, and if you look back here, you'll see these numbers match as we're breaking through here. Where did it go? 117 and 365. Is that right? Hold on. It's this bar right here, the 635 bar. So 316 and 704. All right, so this is actually an object lesson in why we don't want to use that other chart. These are the two bars here as we're breaking through right here. So 117 and 316 on the buy side, 365 and 704 on the sell. Aggressive buying and aggressive selling. And so that's these two here. Not that one, this one here. As we're breaking through, and then the next bar. Okay, so we can put this chart away now and focus specifically here. And what we'd like to understand is, well, okay, so there's 365 cells. What's special about that number? Why is that why is that important relative to these other numbers we see? There was 408 cells back here. Okay, and so really what we're interested in is not so much the absolute value of the buying and selling, but what's the average? And if we can understand, well, what's the sort of the average amount of buying and selling, and then look at, well, is the current amount of buying and selling more than that average by a certain amount? That's interesting stuff. So if my average is, I'm averaging, 100 contracts of selling per bar, and suddenly there's, 200 contracts being sold, that's an indication that there's suddenly a lot more selling, a lot more aggressive selling in the market. Okay, so to do that, let's take a look at the average of the selling. All right, so here, this is the bid volume. This is the aggressive selling going on in each bar. And if we can plot that very easily using Sierra chart built-in functions. This is a moving average, a simple moving average, and I'm using the bid volume. And if I turn that on, it will give us a subgraph that shows us the average amount of selling, of aggressive selling. This is a plot of the bid volume. So the trades that went off at the bid, the trades that represent aggressive selling, what's the average? And you can see, I'm using the last 10 bars. So you can see that it's actually fairly noisy, all right? And in fact, as we were, coming down here to this level, you can see that the average selling was declining. And then, okay, it kind of, as we broke through, it picked up a little bit, really nothing special there. And what you'll find, or rather what I found, is that when I use the total amount of selling in the bar, it's actually very noisy. Or the total amount of buying in the bar, it's fairly noisy. And it kind of didn't matter how you used it. So you could look at the total number of selling compared to the total volume in the bar. You could look at the relationship between the amount of selling and the amount of buying. And I was never able to find something that was consistently useful, all right, or that I felt that the signal to noise ratio was acceptable. It's pretty noisy. And so we have to introduce another concept here, all right? And that concept is related to how the market behaves when it's in a range. All right, so keep in mind now, this is an important point here. This is a range bar chart. And so what that means is I've specified to the software that I want a 10-tick range bar chart. So every bar is only going to be 10 ticks high. And as long as I'm trading inside this price range, it's going to stay in this bar. I'm only going to get a new bar when I break out of this range. So this range is right here, all right? This is the range, the price range of this bar. And so if you think about it for a moment, the bottom of that bar is 59.19 even, the top of the bar is 21.50. I will not get a new bar until either 21.75's trade or 18.75's trade. Okay, now let's take this and make this a little bit bigger, because I need to talk about how the market is behaving as it's trading in this range. So this is a range, right? And so we're very familiar as traders with trading ranges. And what we see is that as the market moves inside this range, it moves up and it moves down and up and down. And at some point, it's setting the bottom of the range. All right. And when you think about it now, understanding how the order flow works, there's trades going off at the bid and the ask that are driving the price up and bringing it back down and driving it up and bringing it down. And as it's going, we've set the high and the low of this range. This is the range of the bar. So let's keep that in mind, that it's this range here, right? We've blown up and we're looking at now. in order for us to create a new bar, we have to trade outside of the range. And in order for that to happen, what has to occur in the market? If this bar is going to break higher, what has to happen up here? And by contrast, if the bar is going to break lower, if we're going to break out of this 10-tick range, what has to happen at the low here? There has to be aggressive selling at the low. Okay, in order for the market to go down, there has to be aggressive selling. There has to be market orders to sell that are placed. In order for it to go up, there has to be market orders to buy. So in order to break out here, I have to have aggressive selling if I'm going to break lower. But not only that, I have to have aggressive selling at the lows of the range. And this is the key point. The selling that is occurring up here is not really that important. All the selling occurring, bringing the market down from the top of the range, doesn't matter. I have to have selling at the bottom of the bar, at the bottom of the range, in order to break out. And by the same token, I have to have buying at the high of the bar. Okay? And so all the trading that's occurring in between, it just doesn't matter when you think about it, if you think it through for a moment. Really what's important is the selling that occurs at the bottom. Only the selling matters. And the buying that occurs at the highs. It doesn't matter how much selling occurs at the buys. It doesn't matter how much selling occurs at the highs. It doesn't matter how much buying occurs at the lows. It only matters how much buying occurs up here, because that's what it takes to break out of the range and continue in that direction. So buying at the highs and selling at the lows. This is what's important. And so what I found is that if I stop looking at the total amount of selling in the bar or the total amount of buying in the bar, and instead only look at the amount of buying at the highs of the bar and the amount of selling at the lows of the bar, I get a much cleaner view, a much less noisy view of what's actually happening in the market. Okay, this is very difficult to do using built-in studies. I had to write a custom study to do this. All right, so let's turn that on for a moment and take a look at it. So this study is bid-ask levels. That's going to give us a subgraph at the bottom that helps us understand how much buying and selling is occurring at the edges of the bar. Okay, just the edges. So down here we're looking, all right, and this is showing us the selling at the edge versus the buying at the edge. The little green parts are the buying and the red parts are the selling. Okay, and in this particular case, in this particular bar, you can see there's only selling going on. There's hardly any buying at the highs of that bar, and there's a lot of selling at the lows of that bar. So now, but if we take the earlier concept of, okay, well, what's the average amount of selling that's occurring at the edge of the bar, and the average amount of buying that's occurring at the edge of the bar, and just look at that, not the total amount, just at the edge. Okay, so for today's purposes, I'm just demonstrating the selling for teaching purposes. So we're going to look, just at the amount of selling at the bottom of the bar. And what I've done is I've specified, well, how much of the bar am I interested in? Okay. And in this case, the answer is I want basically a third of the bar. Just a moment here, I gotta fix. Yeah, the software was trying to reconnect there to the server. Okay, so we're interested in just the selling at the bottom or the buying at the top. All right, and the study down here is calculating that for us. And what I've done is said, okay, give me 1/3 of the bar. I only care about the selling in the bottom third of the bar or the buying in the top third. Okay, now let's calculate the average. What is the average selling at the bottom of the bar as the market trades? And that is being done here with average selling bottom. And that's going to give us a pink line here in the subgraph. Now, the first thing you should notice is how much smoother that line is. Okay. The other, when you're looking at the total, that number is moving around quite a bit. Here it's a lot smoother, and so it's a lot less noisy. And so now, if I look at the bar and I say, okay, how much selling is occurring in this bar compared to the average? But again, it's selling just at the edge, just at the bottom of the bar. And the specific algorithm is 50% more. Do I see 50% more selling at the bottom of the bar than the average? If I do, color it pink. If I see 50% more buying at the top of the bar, okay, color it blue. All right, now, we're going to use this to understand how the market's behaving at key levels. All right. So let's switch back to the chart and understanding now that what we're seeing is when we say big selling or aggressive selling or strength on the sell side, what we mean is we see 50% more selling at the bottom of the bar than the average over the last 10 bars. Okay, let's switch back. All right, so here we are. This is the same chart. And without all the detail and all the messiness of the numbers that you're having to decipher, it's just displaying for you a pink bar when I see 50% more selling at the edge than the average. All right, and so what do we see here? From a wave volume perspective, we've got divergence and no interest short. There's a level set here. We break through, big selling. 50% more selling at the bottom of that bar. And in fact, it continues, right? It looks like it's just going to fall apart. We're going to talk about in a lot more detail in part 3 how we actually use that at a breakout to make a decision on whether or not I want to enter the market. Do I think that breakout's going to succeed? For now, we need to make sure we've got this concept understood, that when we see a pink bar or a blue bar, what we're seeing is that there's a dramatic increase in the amount of aggressive selling compared to the average, or aggressive buying compared to the average at the edge, only the edge. And this is by limiting it to the edge, we're eliminating a lot of the noise that we see as the market trades up and down inside that range. Because again, we really don't care what happens in the middle of that range. And in fact, we don't care what happens even at the top of the range if the market's going down. We're only interested in selling at the bottom and buying at the highs. All right. So to review, this is the end of this part of our video series on trading the markets using visual order flow. We've covered wave volume in part 1. Here in part 2, we went over the basics of order flow and how bid and ask volume represent who's being more aggressive in the market, the buyers or the sellers. We then looked at ways to calculate the total amount of buying and selling in each bar, all right, and create an average of that, and then compare the current bar to the average to see, are we seeing more or less? And my discovery was that that's a very noisy signal. And as a result, we discussed how if you consider the fact that a range bar is trading in a range, then you really only care about the buying at the top of the bar, since you need aggressive buying at the top in order to break out. And you need aggressive selling at the bottom in order to break out lower. Okay? And so this concept of the order flow that's occurring at the edge of the range, at the edge of the bar, is key. And we then take that volume, the volume of selling at the bottom of the bar and the volume of buying at the top of the bar, and we average that over the last 10 bars to get an understanding of, okay, well, what's normal? And then if we see a dramatic increase in the amount of selling at the bottom, we color that bar pink. And that helps us understand, okay, we're seeing sellers step in, aggressive selling enter the market. By the flip side, if we see an increase in the amount of buying at the top of the bar, then we're seeing aggressive buyers step into the market. Okay, so this ends part 2. Next part, we'll be talking specifically about how the market behaves at key levels and how we can use order flow to make a decision on whether we think that breakout's going to succeed or not. And I'll also cover specifically how I choose to enter the market under those conditions.